Stop scrolling right now because what I am about to tell you could be the difference between watching your wealth slowly evaporate or understanding one of the most important financial shifts of this decade. While the mainstream media is busy talking about tariffs on cars, electronics, and consumer goods, something far more important happened quietly, almost invisibly, in the background. An executive order was signed that fundamentally changed the rules of the game for precious metals and especially for silver. This is not just another trade war story. This is about how the United States government just created a protected zone inside the global economic battlefield. And almost nobody noticed. When this administration came back into office, it did not waste a single minute. Within hours, executive orders started flying. Reports were demanded, trade practices were reviewed, tariff frameworks were prepared, and then the hammer fell. Using the International Emergency Economic Powers Act, the government declared that the trade deficit itself represented a national emergency. This single legal move allowed them to impose sweeping reciprocal tariffs across the entire world, a baseline 10% tariff on almost everything. But that was only the beginning. Some countries were hit with 20%, 30%, and in certain cases, tariffs above 100%. China saw tariffs explode up to 125% before temporary reductions. The European Union oscillated between 20 and 50%. Canada and Mexico were hit with 25% tariffs tied to border and security issues. Steel and aluminum were slammed with 25% under national security provisions. Automobiles and parts were targeted. Copper was investigated. Pharmaceuticals, semiconductors, lumber, and critical components all came under threat. The message was clear. Nothing is safe. Global trade did not just slow down. It started to fracture. Supply chains that took decades to build were suddenly in question. Prices began shifting. Companies froze investments. Retaliatory tariffs came back from Europe, China, and others. And in the middle of all this chaos, something strange happened. Hidden deep inside the executive orders and their modifications was a list, an exemption list. And on that list was one word that immediately caught the attention of anyone who understands money: bullion. According to the official White House documentation, certain goods were added to a special category, meaning they would not be subject to reciprocal tariffs. These goods included bullion-related articles. In trade language, bullion means gold, silver, platinum, and palladium in the form of bars, coins, and ingots. Gold was explicitly named. Silver, platinum, and palladium were included under the same category by industry consensus and regulatory interpretation. The National Coin and Bullion Association immediately confirmed it. Precious metals would remain tariff-free. This was not a small technical detail. This was a massive strategic decision. Because while almost everything else in the global economy was being taxed, punished, and weaponized, precious metals were placed in a protected zone. And here's the key point. This was not done because the government loves precious metals investors. It was done because the United States has no choice. The U.S. does not produce nearly enough silver to meet its own needs. Silver is not just a shiny metal for coins and investors. It is a critical industrial resource. Solar panels, electronics, medical devices, batteries, water purification, military systems, advanced manufacturing. All of it depends on silver. If tariffs had been placed on silver imports, industrial costs would have exploded overnight. American manufacturers would have faced massive input cost increases. Those costs would either be passed to consumers or destroy profit margins. Either way, the policy would have sabotaged itself. But there is something deeper here. By placing precious metals in a protected category, the government is implicitly admitting something most people do not think about. Bullion is not just another commodity, it is money. It is a strategic resource. It is a store of value that sits above normal trade politics. And this is where the story becomes really interesting. Because the moment this exemption was confirmed, the precious metals market reacted. Premiums on platinum and palladium dropped. Dealer spreads tightened. Uncertainty disappeared. But silver is different. Silver sits at the exact intersection of money and industry. And that makes this exemption far more powerful than it looks. Silver is now entering the United States tariff-free, while many of the products that contain silver are being hit with massive tariffs if they are made abroad. Think about what that means. It means the raw material flows freely, but the finished goods get punished. This creates a powerful incentive to move manufacturing back to U.S. soil, import the silver, build the product in America, avoid the tariff entirely. This is not accidental. This is industrial policy disguised as trade war, and it sets the stage. Now that you understand what happened, we need to talk about something far more important than the executive order itself. We need to talk about what silver really is and why this exemption changes its role in the global economic system in a way that most people are completely missing. Silver is not just another metal. It is not just another commodity you trade on a screen. It is one of the very few materials on Earth that plays three roles at the same time. It is money. It is an industrial input, and it is a strategic resource. And the combination of these three roles is what makes this entire situation so explosive. For thousands of years, silver has been money. Not a promise, not a contract, not a digital entry in a database. Real money. Something that exists even if governments fall, banks collapse, or currencies are reset. Empires have risen and fallen, but silver and gold have always remained. That is not ideology, that is history. When paper currencies fail, people do not run to more paper. They run to tangible things that cannot be printed. But silver is not only money. Unlike gold, silver is deeply embedded in the physical economy. It is consumed, it is used, it is transformed into things that never come back. Electronics, solar panels, medical equipment, chemical processes, advanced manufacturing, military systems, water purification, communication networks. Silver is everywhere, and a large part of it is lost forever in tiny components that are not economically recoverable. That means silver is not just stored, it is gradually disappearing. This is a critical difference. Gold mostly sits in vaults. Silver gets used up. Now combine that with what is happening in the world right now. Tariffs are spreading, supply chains are fragmenting, costs are rising, governments are weaponizing trade, inflation pressure is building, uncertainty is becoming the new normal, and in the middle of all this, silver has just been placed in a protected category, exempt from the very taxes that are making everything else more expensive. That is not a coincidence, that is not a gift, that is a necessity. The United States and most industrial countries cannot function without silver. Modern civilization literally stops without it. No advanced electronics, no reliable power systems, no modern medical technology, no renewable energy infrastructure, no high-performance military systems. This is why silver is classified as a critical mineral. This is why its supply chain is being studied under national security laws. This is why it was politically impossible to put tariffs on it. But here is where things become really interesting. While silver itself is exempt, many of the products that contain silver are not. Solar panels made abroad, electronics assembled in China, medical devices produced in Asia. All of these are getting hit with tariffs. The raw material flows freely. The finished goods get punished. This creates a powerful and very intentional distortion in the economic incentives. If you are a manufacturer, you now have a choice. Import finished goods and pay heavy tariffs, or import the raw silver tariff-free and build the product inside the United States. This is industrial policy without saying the words industrial policy. And this is why the silver exemption is not just about metals. It is about reshaping where things are made. Now think about what that means for demand. If even a portion of manufacturing comes back, domestic silver consumption rises. At the same time, global silver production is not growing in any meaningful way. The big producers are Mexico, Peru, China, Australia, and Russia. The United States produces some silver, but nowhere near enough. New mines take years to develop, permits, financing, infrastructure, politics. You cannot just decide to double silver production next year. So you have a situation where industrial demand is structurally rising, investment demand tends to rise during periods of uncertainty, and supply is slow, constrained, and inelastic. That is not a balanced market. That is a market under pressure. And then there is the monetary side of the story. Trade wars always create currency stress. When countries are hit with tariffs, their exports fall, their growth slows, their currencies weaken. When deals are signed, currencies move again. This kind of environment increases volatility in exchange rates, bond markets, and capital flows. Historically, this is exactly when investors look for assets that do not depend on any single government or financial system. Gold is the traditional safe haven, but silver often behaves like gold on steroids. Smaller market, thinner liquidity, more volatility. When it moves harder. That makes it more dangerous for short-term speculation, but potentially more powerful as a long-term asymmetric hedge. Silver is not just reacting to inflation. It is reacting to systemic stress, and we are entering an era of systemic stress. There's also a strategic and military dimension that most people never think about. Modern weapon systems are full of silver, guidance systems, communications, radar, power management. The same is true for advanced energy systems, satellites, data centers, and critical infrastructure. A disruption in silver supply is not just an economic problem, it is a national security problem. That is why the government treats silver differently from copper. Now let us bring this story down from the level of geopolitics and executive orders to something much more concrete. Your life, your wallet, your daily expenses. Because whether you own silver or not, whether you care about financial markets or not, this decision is already affecting you and will affect you more in the coming months. Silver is not an abstract concept. It is inside almost everything you use. Your smartphone contains silver. Your laptop contains silver. Your television, your refrigerator, your washing machine, your car, your internet router, your air conditioning system, your medical equipment, all of them contain silver. Sometimes in tiny amounts, sometimes in more significant quantities, but it is everywhere. Modern civilization is built on it. Now here is the crucial point. While silver itself is exempt from tariffs, most of the products that contain silver are not. That means the metal inside your devices can enter the country without additional tax, but the finished product, if it is made abroad, gets hit with tariffs that can range from 10% to 30%, and in some cases much more, depending on the country of origin. What does that mean in practice? It means prices go up. Not theoretically, not eventually. They go up in real life. The company importing the product pays more. That cost does not disappear. Either the company accepts lower profits, which investors do not like, or it raises prices, which is what usually happens. The result is simple. You pay more for the same thing. This is how tariffs become inflation. It is not complicated. It is mechanical. That new phone you were planning to buy, more expensive. That laptop upgrade, more expensive. That smart television, more expensive. The replacement part for your car, more expensive. Even things like medical equipment, which are supposed to be protected from political games, end up being affected because many of them are still manufactured abroad. Now, here's the irony. The silver inside those products is not the problem. It is the rest, the labor, the assembly, the logistics, the components. The tariffs are applied to the finished good, not the raw material. This is why the silver exemption is acting like a pressure valve. Without it, prices would be rising even faster. But do not misunderstand. Prices are still rising. For people on fixed incomes, retirees for example, this is devastating. Your pension does not suddenly increase because tariffs went up. Your savings do not magically buy more. In real terms, your purchasing power goes down. For workers whose wages do not rise as fast as prices, this is a silent pay cut. This is one of the reasons why inflation is so politically dangerous. It does not hit everyone the same way. It hits the weakest first. Now let us talk about energy, because this is where the silver story becomes even more important. Solar panels use silver to move electricity inside the cell. It is one of the most expensive materials in the panel. The world is pushing massively towards solar energy. Governments are subsidizing it. Companies are investing in it. Entire energy strategies depend on it. If silver had been tariffed, the cost of solar panels would have exploded. The energy transition would have slowed down. Electricity prices would have gone even higher. The exemption prevents that. But here's the twist. Many solar panels are still made in China or other countries now facing heavy tariffs. So even though the silver is cheap, the panel is not. This is why you are seeing a huge push to build solar panel factories in the United States. The logic is simple. Import the silver tariff free. Build the panel locally. Avoid the tariff. Suddenly, what looked like a trade war becomes industrial policy. The same logic applies to medical equipment. Silver has antimicrobial properties. It is used in wound dressings, surgical tools, catheters, and many other critical devices. Healthcare costs are already out of control. If silver had been tariffed, costs would have gone even higher. The exemption helps. But again, if the device is made abroad, the finished product can still be taxed. So once again, the incentive is clear. Build it at home. Now let us talk about jobs, because this is always the political justification for tariffs. Bring manufacturing back. Protect workers. Rebuild the industrial base. The silver exemption actually supports this goal. It makes it cheaper to produce silver-based products in the United States than to import them fully assembled. But here is the reality. Factories do not appear overnight. Workers need to be trained. Supply chains need to be rebuilt. This takes years. In the short term, you get disruption, higher prices, uncertainty, volatility. In the long term, if it works, you might get more domestic production and more jobs. But there is no guarantee. Economic history is full of policies that looked good on paper and produced mixed results in reality. Now let us talk about money itself. Tariffs are inflationary. This is not ideology, it is arithmetic. When imported goods cost more, the general price level goes up. The central bank then has a problem. If it raises interest rates too much, it risks recession. If it keeps rates too low, inflation stays high. This is a very uncomfortable position. And in this kind of environment, assets that do not depend on interest rates become more attractive. Silver does not pay interest, it does not produce cash flow, but it also does not get diluted by money printing. This is why, historically, during periods of inflation and monetary instability, precious metals tend to perform better than paper assets. Now let us talk about the psychological side of this. It's when people start to see. Now let us step back and look at the full picture. Because if you only look at silver, you miss the real story. This is not just about one metal. It is about the direction the world is moving in and what that direction means for your money, your savings, and your future. For decades, the global economic system was built on one assumption that trade would become more open, more fluid, more interconnected, that supply chains would stretch across continents, that efficiency would always beat resilience, that cheap production would always beat local production, that money could be printed, debts could be rolled over, and nothing truly serious would ever break. That era is ending, not because politicians decided it should, but because the system itself has reached its limits. Trade wars are not an accident. They are a symptom. They appear when too many countries depend on each other for critical resources, while at the same time no longer trusting each other. They appear when debt becomes too large, when politics becomes too polarized, when populations become more anxious, and when governments start choosing control over efficiency. Tariffs are not just taxes. They are signals. They are borders inside the economy, and once borders start coming back, the world does not return to the old model easily. We are entering a period of fragmentation, economic blocks, currency blocks, strategic resources, protected industries, reshoring, friendshoring. All of these words describe the same transformation. The global machine is being taken apart and rebuilt in a more defensive form. This is not necessarily bad, but it is not smooth, and it is not cheap. Fragmentation means duplication. Duplication means higher costs, and higher costs mean inflation. At the same time, government debt levels are exploding almost everywhere, and the political solution to every problem is more spending, more deficits, more money creation. That is how modern systems buy time, but buying time is not the same as solving the problem. The dollar is still at the center of the system, but for the first time in decades, more and more countries are actively trying to reduce their dependence on it, not because they hate the dollar, but because in a world of sanctions, asset freezes, and financial weaponization, dependence becomes a risk. This does not mean the dollar is about to collapse, but it does mean the system is slowly becoming more multipolar, more fragmented, more complex. In that kind of world, assets that do not belong to any country, any central bank, or any political system become more important, and that is exactly where precious metals live. Silver is not special because it is shiny. It is special because it sits outside the promises. Now look at the industrial future. The world is not becoming less technological, it is becoming more. Artificial intelligence, data centers, electrification, electric vehicles, renewable energy, medical technology, robotics, advanced manufacturing, all of these things require more silver, not less. At the same time, mining is not getting easier, or grades are declining, environmental rules are stricter, political risk is rising, and new mines take a decade or more to bring online. That is what economists call inelastic supply. You cannot respond quickly to rising demand. This does not guarantee higher prices, but it creates a permanent tension that did not exist in the same way before. On the investment side, we are in the middle of the largest generational wealth transfer in history. Trillions are moving from older generations to younger ones, and younger generations do not think about money the same way. They are more skeptical of institutions, more aware of inflation, more aware of debt, and more aware that the system is not as stable as it looks. Trust is the real currency, and trust is being spent very fast. Now let us talk about strategy, because this is where most people make either smart decisions or very expensive mistakes. Silver is not a magic solution. It is not a get-rich-quick scheme. It is a tool for diversification, a tool for resilience, a tool for insurance. A reasonable approach is allocation, not bets. 5 to 10% of a portfolio in precious metals for conservative profiles, maybe 10 to 15% for more aggressive ones. Not all in silver. A mix of gold and silver, gold for stability, silver for optionality. Then you choose the vehicle. Physical metal if you want independence from the system, but accept storage and liquidity costs. ETFs if you want simplicity, but accept counterparty risk. Mining stocks if you want leverage, but accept business and market risk. There is no perfect solution, only trade-offs. The biggest mistake is timing. People want to buy the bottom and sell the top. Almost nobody can do this consistently. That is why dollar cost averaging exists. You buy regularly and remove emotion from the process. Another mistake is expecting silver to behave like a growth stock. It does not. It can do nothing for years and then move very fast. Another mistake is forgetting taxes, storage, and spreads. These costs matter. Another mistake is going all in because of fear. Fear is a terrible investment advisor. There are always risks. Policies can change, tariffs can be removed, trade deals can be signed, inflation can fall, rates can rise, technology can reduce silver intensity, recycling can improve, mining can surprise. There are no guarantees. But there is also risk in doing nothing.